Rightio. Thank you everyone for coming in and joining us on Friday. Beautiful winter afternoon. Just for a quick one, my name's Brendan Gleeson. I'm one of the senior financial advisors here with the GP Wealth Team Insurance Partners. And today we're going to be hearing about the private equity space, but in particular, Tim Cooper from 5V Capital. In terms of Tim's experience and background, he's been in the industry and worked in a range of areas such as private equity, strategic investments, and M&A for over 20 years, with experience with Champ Ventures as well as Macquarie, I believe, from the profile. And is a big part of 5V and their growth over the last number of years to become one of the market-leading private equity managers in the country. So, in terms of space, the background, we're privileged to be able to share on some of that today. And Tim will be talking a little bit about their fund, the private equity space, as well as some of the ways that they invest in their process, in their investments, and hence the opportunity and excitement that is behind a lot of those investments. But before we jump into that, just as a bit of context about why we're so keen to kind of promote more of this space, is that private equity is an area that's undeniably getting bigger. I think it's more than doubled in terms of fund flow and capital over the last 5 or 6 years. But just check me on that stats. And ultimately, it is a pretty broad space and a rather opaque space. So understanding where you're investing, how you're investing, and who it's with is unbelievably important. Ultimately, when we're talking to clients, we're always being asked, how can we deliver higher returns with lower risk? And ultimately, at the moment, more and more markets are becoming, the relationship between different asset classes and shares and fixed income is just getting higher and higher. Be able to diversify your portfolio away from listed or from different asset classes is becoming increasingly more difficult. Private equity is now a conversation that is becoming significantly more prominent with helping solve that problem. Historically, it's been an area where you've had to have needed probably 10 million or whatever the amount might have been to be able to access that. And they tie your money up for 5 or 6 years, and you'd hope that you got in at the right time and you got out at the right time. So it's a difficult area for a lot of investors such as ourselves to really be able to appreciate or get excited about. But the innovation and the development of that space has solved a lot of those problems, where now the 5V Group is able to help us access that area and offer quarterly liquidity, but still give us the benefit of getting access to those opportunities that we can't get access to in listed markets through a quality manager, a well-executed process, and history of performance. So in terms of the space and the excitement around the area, but the last one is also about, there's a number of managers in the market, and we've basically sat down and visited with them all. You want to find a manager that's got all those key ingredients with regards to, track history, quality management, transparency, integrity, and 5V's undeniably got all of that. But you also want to find a manager that has an edge, an ability to eke out performance beyond your other manager, your average manager in the marketplace. And I think that the hunting ground in the area that 5V play in has got an undeniable opportunity in front of it. Hence why we're excited about being partners with them and have been over the last year, and we're increasingly doing so going forward from here. So hopefully it gives a bit of context and a bit of perspective on what we're going to be hearing about. I think Tim's going to speak for about 40 minutes. If we could just hold off on questions towards the end, as we are recording for those who aren't able to make it today. But without further ado, I'll hand over to Tim and take it from there.
Thank you, Brendan. Thanks, everyone. Thanks for having me. It's great to be here with you, and thank you for lunch also. That was delicious. I ate very quickly, but it was very, very nice. So thank you. So look, as Brendan said, I'd love to use the time just to talk to you about a bit on sort of private equity, maybe just go a little bit deeper on some of the points that Brendan was making. I think then sort of within that, why we think Australian mid-market private equity is a really exciting place to be investing your capital. And then ultimately, a little bit more around 5V, what we're doing. And then, I might touch on just a few of the example portfolio companies as well. Just try and sort of bring it to life a little bit more in terms of what we're doing on a day-to-day basis. I think the sort of start top down, I think the first important point, and Brendan sort of touched on this, that private equity does deliver superior returns. And I think importantly so over whatever period of time you look at, and across and through sort of market cycles as well. So this ability to drive very attractive returns with lower risk, I think, is a central tenet of why we invest our own personal capital in this space, but why we think that, when we engage with people like Shaw and Partners, why they're so excited to be talking to their clients about this part of the market as well. And the truth is that this has been a well-known stat for a long period of time. And so those investors who've been able to do it and been able to access this part of the market have been doing so. And so, I think the big shift that's playing out sort of globally and which, from a 5B perspective and a Shaw and Partners perspective, we're seeking to play into and give access and opportunity to, is the fact that these large-scale endowments, sovereign wealth funds in particular, but sort of institutions writ large, have been investing in the private equity or private capital, of which private equity is a very significant component for a long period of time. And Future Fund, obviously a well-known business here, but even globally held up as a sort of gold standard around asset allocation. They have always had a very strong allocation to private equity. And you compare that to the individual investors in this room, or more broadly, typically have very, very low exposure. Might have some through a small allocation through a super fund, but typically getting access to private equity funds. Even our own, we're a relatively small manager on a global scale. But even to access our closed-ended funds, there's a multi-million-dollar commitments, and with all the challenges that that Brendan mentioned before. And so I'll talk today around Horizons Fund, which is trying to sort of effectively solve this this issue or this statistic that's on the previous page. And so if you accept the premise that private equity is an exciting place to be deploying capital on a risk-adjusted basis to achieve attractive returns, well, private equity is actually, even though it's two words, it actually describes a very, very broad set of opportunities across different asset classes, across different sizes. And so really then the question is, well, let's get a bit more specific around where do you want to be within the private equity landscape. And I think when we talk about the mid-market in the Australian context, we're really talking about businesses that are the backbone of the Australian economy. So Australia is a big country that's made up of lots and lots of small businesses. If you want to buy multi-billion-dollar businesses in Australia, there's just not that many of them. But if you want to buy businesses that make up to $250, $300 million of revenue, there are lots and lots of those businesses. And I think importantly, naturally a comparison that people will draw is that compare it against public markets. And the way we think about this is there are roughly sort of nine to 10 times as many private companies that exist in Australia as there are public companies that you can invest in. Or put differently, 90% of the sort of addressable universe of businesses in Australia are private. And so, and I'll come to talk on it in a little bit, but what we've had to do then is, if you think about the blue bar on that page, okay, you get a Bloomberg terminal and you start your research and you go to a stockbroker and you say, hey, I'd like to buy this stock. Yeah, that is relatively straightforward. Now, obviously, you've got to pick the right ones, but in terms of accessing them is relatively straightforward. What we've had to do is create an entire business and a platform that allows us to go and hunt in that orange folder. So kind of how do we take that addressable universe and start disaggregating it in terms of what are the attractive businesses within it? Where are the founders and management teams that we want to be engaging with? And so frankly, the good news for us is that we are sort of spoiled for choice. The challenge is that often those businesses are sort of hiding in plain sight. We've actually got to go and find them. We've got to have the capability to be able to go and unlock those, have the conversations, engage with founders and business owners over long periods of time. And so when I talk about 5E and how we're set up, it is all through that frame of reference of how do we go and prosecute the opportunity that exists within these businesses. And so there's lots of these businesses, as I've just mentioned. And I think the really exciting thing for us, and really, again, what we've set our whole business up to do, is that lots of these businesses are also now in this really interesting transition phase. So to be clear, we're not trying to buy the business that was set up by the 19-year-old university dropout, kind of startup style business. This is about buying established, profitable, proven businesses over long periods of time. And typically what that means is that they are founders, owners, and entrepreneurs who are reaching a point in their sort of age and stage of life where they're thinking about, well, I've built this pretty big asset and this business has been very successful. What am I going to do with it? How do I monetize it? How do I think about succession? And a portion of those businesses will obviously stay within families and they'll transfer to kids and take them over, or grandkids. But actually, a large portion of those businesses, they will need to find some monetization avenue. And so, again, we've set up our whole business to be able to go and find those, have great conversations with those founders, owners, and entrepreneurs, ultimately be custodians of those businesses for a period of time, partner with those founders and owners, and then ultimately, over a period of typically sort of 4 to 5 years, work on facilitating ultimately then a full transition out of those businesses for those founders. And so if I talk about sort of 5V sort of within that, and again, I've mentioned, a few of the things that we're sort of trying to solve for, just to give you a bit of context around us and what we're doing. So today, 5V Capital, we're based here in Sydney. Our headquarters are just outside the city in Darlinghurst. We have a team of over 50 people. I think it's 55 people now. So sort of a little hard to keep up. That stat moves reasonably quickly. We've been around for about 10 years. The sort of the history of the firm and the founding of the firm is that essentially all of us, and I've been at the firm since 2016, all of us had come out of large-scale institutions investing globally. And what we wanted to do was take some of the best practice that we'd seen in those institutions, and lots of myself, I come from Macquarie, obviously very, very successful organization, and take some of that best of breed approach, institutional discipline, but just frankly apply it to a part of the market where, as I said, there's lots more of those businesses. Frankly, we think you can add a lot more value to them as well. And candidly also, it's just more fun. It's just more interesting. You get to work with these great owners and entrepreneurs. You get to invest in these fantastic Australian success stories. And the reason that was important was because a central premise of what we wanted to do as 5V when the business was set up was orientate around this principle of alignment. And so, when we first set up the business, and it still remains the case today, that the largest single investor across the 5V platform is the team at 5V. And so today we've invested sort of over $200 million of our own capital across these opportunities. And so, whilst that's no guarantee of success, ultimately we still have to make the right investments and work with those businesses constructively and deliver great exits. We do think that it is a great sense check on, hey, is this a business that we really want to invest in? Is this a founder and an owner that we really want to partner with? And ultimately, that principle of alignment, it's great for our investors. They love it. They love that we're leading with our chin. They love that we share upside and downside, importantly. But it's also great when we go and we talk to these owners and founders and entrepreneurs. And, for some of the Shaw and Partners clients in this room today, I'm sure you've built businesses. You understand the value of a dollar. You know how hard it is to allocate capital, and I guess how high the bar is to be allocating your own capital. And so that's, again, a central premise when we go and we talk to these founders, owners, and entrepreneurs. I think, sort of importantly, I guess the conversations that we're having with these business owners, and I think it's an important point to stress, because often people think, private equity, okay, great, lots of debt, strip out costs, kind of see what happens. I think importantly, that's not what we're trying to do. Now, there are people who do that, and that can be a successful investment strategy, but it's just not our skill set. The conversations we want to be having with these business owners is one orientated around growth. So existing business performing really well, playing into some great tailwinds and thematics. We want to be having a conversation around, how do we do more? What could you do if you were unconstrained by capital availability, or, we think our involvement will allow you to attract even better talent into the business. What if we helped you to go into an overseas market? Have you ever thought about buying another business? And if we can have those conversations, then that's it's really, really powerful. And the way we sort of talk about it is combining founders and management's depth of expertise in their particular field, in their particular niche, combined with our sort of breadth of experience around scaling, growing, and these businesses, and ultimately growing shareholder value within them. We are active investors. The private equity model, to varying degrees, but I'd say as a general statement, the private equity model is one of high engagement, and so we identify these opportunities, we make an investment, and then we work very closely with those businesses. So sit on there's board meetings in around maybe tables slightly smaller than this, but sort of broadly sort of around tables like this. That provides the sort of the formal governance backbone for the investment. But then it's very regular dialogue with the CEOs, CFOs, chairs, founders. Very sort of dynamic. We want to be able to make decisions quickly. We want to be able to capture opportunity, and we want to be able to play into the opportunity that exists in front of these businesses. And I think sort of lastly, and perhaps most importantly, 5V, we're also a registered B Corp. So for those who don't know what that is, that's effectively a sort of global gold standard around combining both for purpose and for profit. So we think that absolutely we exist to make great returns for our investors, and that is a primary function of what we do, or primary goal of what we do. But we think we can do it in the right way as well, and we think we can do that in the right way in the communities in which we invest and engage, how we treat our team, and ultimately how we treat and engage with people in the broader ecosystem as well. And so then, sort of what are we looking for, I guess, is sort of be the next question. So if we're working down, I guess, the filtering spectrum here. We've got private equities, a good space. Mid market is excellent within that. Okay, great. 5V, you've got this big team, and you sort of we set up for success. But what are you actually trying to spend time on and focus on? So the way we sort of think about it is that we are investing firstly in ANZ headquartered businesses. So I mentioned we've got a main office in Sydney. We also have an office in Auckland as well, and a team on the ground in New Zealand. Also a great market. It's just small, so you have to be appropriately sized there. But we think having boots on the ground in New Zealand is really additive. And so we're looking for ANZ headquartered businesses, which typically have demonstrated success locally, but are also exporting their good or service offshore as well. It's not necessary day one, but we do think that it's important to have that ability to do that over the long term. And we think, first reason would be obvious to everyone, sort of you just open up a bigger market that you can play into. But I think the second point that's important is that what it also generally does is it brings you into the sphere of acknowledgement of people who may well be the logical buyers of the businesses as well. So all of a sudden, someone in Ohio, in New York or Ohio or London or whatever is going, what's this business out of Australia that we keep hearing about? Should we buy them? That's ultimately what we'd like to achieve. We do focus on this mid-market space, as I've said. For us, that means typically businesses that are valued sort of anywhere up to sort of $350 million or so. We're looking to back leaders within their niches, as I said, and I'll touch on some of the examples later. But these are all businesses that are, they're in some way disruptors. They're leaders in their niche. They're typically taking market share, so they're growing sort of above system growth or above market growth. It's really, really important from our perspective. And importantly, again, just to reiterate it, these are profitable businesses. So they're businesses that have a proven track record. Ultimately, you can orientate around a cash flow profile that means that it gives you a good view of downside protection as well. I think because we're investing so much our own capital in these opportunities, we are thinking, yes, we're thinking about all the good things that could happen, but we're also thinking about hey, the world's pretty uncertain, and what happens if we went through a period where things were a little bit softer? Can we make sure that we can preserve capital first and foremost, and ultimately have a resilient business that we can bounce back from? And then we do have the flexibility to be able to do what we would call, or we would sort of term, significant minority, so 30-40%, plus all the way through to kind of notionally 100%. Usually we don't really go above sort of 80% because we are trying to have that sort of founder or business owner partnership. I think importantly, again, back to this point around, we're active, we're sitting on the board, we've got proper rights under the shareholders agreement. Even in a case where we end up owning 30-40% of the business, those things still all hold true. So just importantly, that capital and the way we interact with the businesses, the protections we have, are still are consistent, are broadly consistent across that ownership spectrum. I think this is a stat, and I'll try and explain it because maybe it's not self-evident from the slide, but this is probably the statistic we would be most proud of across the whole 5V business. So we've sort of working left to right. We make investments. We partner with these founders and owners and entrepreneurs. We convince them that we'd be great partners for them. They retain a stake and come on the journey with us. And so again, back to this sort of format, we're sitting around the table, we're talking to them on a weekly basis. We're trying to grow value with them. And that's what we're doing in that sort of the darker blue box. They remain very engaged and they retain an economic stake. Ultimately, then there's an exit event. And typically what we would do at that point is there is a transaction for 100% of the company. So that would see both 5V exit, but also the original founder as well. And in 100% of cases, those founders or business owners have then taken a portion of those proceeds and given them back to us to reinvest into whatever our sort of latest fund is at that point in time. And I think the reason we're super proud of that is that they've seen us up close. They've worked very closely and collaboratively with us. And candidly, I think anyone who sits in front of you, and anyone from an investment firm who sits in front of you and says, it's always up and to the right and everything's easy and rosy. There are a bunch of really difficult conversations you have to have at times in business, as lots of people in this room would know. We've been fortunate that our returns have been fantastic, and we have been able to grow shareholder value very strongly. But we'd be lying if we said that it was a straight line journey. There's always ups and downs. And so to have been able to have, I think, a bunch of pretty difficult conversations at times with some of these founders, often tied to, hey, now might actually be the right time for you to take a less active role in the business, and to actually be able to have those conversations in a way that they still then ultimately want to trust you with some of their proceeds and their capital, and for you to be able to reinvest that. We think that's we struggle to think of a higher sort of measure of success, I guess, in that relationship strength. So again, it's something we're super proud of. And so then we work with these businesses. As I said, it's very active engagement. But maybe a question would be, well, what are you actually trying to focus on? I think sort of governance is maybe not the most interesting one of the things on this page, but it's actually really important. It provides the bedrock for a bunch of exciting things that you can do. And often these are businesses where this is actually a pretty significant change for these businesses, because typically they've been, as I've said, founder-led, single shareholder or few shareholders. They go down to the pub, have a couple of beers, decide what they're going to do, for the next 6 months, and that's the planning kind of done, and they don't really have to answer to anyone. And so what we're trying to do here is not be burdensome or overly so, but absolutely just put some rigor around, hey, we said we were going to do X. Has it been done? Have we got the audit done? Are we tracking how we said we were going to be? Are we minimizing distraction within the business? Because often these businesses have lots of opportunities and things they can play into. And I think that really links into the second point, which is we are fortunate enough that these businesses have multiple growth avenues available to them. And so how do we make sure that we keep them really focused on what they're doing? And that network piece within it is also important. There was really sort of two central premises that we founded 5V was sort of founded upon. I've touched on alignment. The second was actually network, which was a view that capital is relatively fungible, and frankly there's lots of it, in existence. And what we deliberately set out to do was to go and bring investors into our sort of orbit and into our ecosystem who were value adding. It was sort of capital plus. And so lots of those investors are very similar to types of people in this room. They're relevant to this market. They've built businesses. They're well networked. They're well connected themselves. And we try and have as personal relationship with them as we can. That's maybe a bit of a disclaimer. If you end up an investor in 5V funds, don't be surprised one day if you get a phone call saying, "Hey, we saw you're involved with this. Could you help us on X and Y?" But we think that's great. It adds a lot of value to our portfolio companies. Ultimately, it's great for our investors. Typically, our investors have, they're not that we do have institutional investors, but our individual investors, they don't have lots of private equity exposure. And so they like the fact that they can have a very personal relationship with us. And it's great. And it's added a huge amount of value to our businesses over time. I think the third, I was having a conversation with Lynn before, just around sort of AI and AI disruption. I think, the technology and operations piece, I think, yes, there's some AI sort of, lots of AI stuff that we're doing and thinking about, but actually often can be even just more nuts and bolts than that, which is, again, a founder-led business that typically has been more focused on revenue rather than, hey, let's put in a new ERP system. Again, that's totally appropriate and fine. But if we're trying to double, triple, quadruple the size of these businesses and then ultimately present them as scalable and robust businesses when we go to exit them, then we also spend a lot of time thinking about, have we got the platform to enable growth of that business. And then the last piece, M&A and bolt-ons. We are very active as well, thinking about both how we drive organic growth within the business, but then also are there logical acquisitions that we could do both domestically and internationally as a way to accelerate that growth, accelerate capability, build scale, et cetera. And that's an interesting one because often founders haven't done a huge amount of that in the past. They've often thought about it and thought, actually, geez, that would be really, really interesting. But I think one is sometimes risk profile, two is time and hours in the day, sometimes funding, and then I guess just the expertise to well and good buying a business, but then you've got to integrate it, you've got to deal with sort of the people issues that come out of it, you've got to make sure that you're, that sort of everything that happens post the acquisition, that's actually where the value gets created. And so, it was we're following the journey through here. And so, we come to the end of our involvement with the business and we talk about exits and ultimately that's the return crystallization point. I think there's a few things to call out on this page, and this is just a bit of a cross section of some of our exits. I think importantly, when we're thinking about, again, one of the reasons why we like this space and where we're investing so much of our own capital is that if you can build these businesses and you can execute on the things I was talking about on the previous slide, then you actually end up with lots of optionality and lots of available kind of exit avenues, I'd call them. So there's sort of three main paths denoted by the different colors, so the green, the orange, and the blue. And again, this is very different to if you're trying to buy multi-billion-dollar businesses where often you're very reliant on public markets for IPOs, for exit, or you need someone to make a decision to deploy billions of dollars of capital into the Australian market. Whereas we're really trying to serve up to that orange group, the strategic buyers. We're trying to serve up really kind of like meaningful but bite-sized acquisition opportunities for, the exam works, Verdum Corey's, most recent one was APP, just out to the right-hand side. The Bureau Veritas, that's a multi-billion-dollar French strategic buyer. And we knew that infrastructure and Australia were two very important segments for them. So we were able to sell APP to them. So those strategic buyers they'll exist, and there's a good bite-sized opportunity for them in the Australian market. Private equity on the left-hand side of the page. Again, like I said, we're by no means the largest private equity firm. There are plenty of players who are larger, who have more capital. Frankly, they have a deployment issue, which is, they're trying to find good opportunities that they can invest into. So again, we think we can serve up great opportunities to them. And then, if it's right and it's appropriate on the far right-hand side, you do have the ASX, you do have public markets available to you. Now, as we all well know, that's a more fickle, more fickle path. But actually, there are some businesses or sectors that are really well supported by public markets. So Universal Store was a specialty retail business that we invested in. Specialty retail, very well bid on the ASX market. Lots of comparable businesses. People could say, hey, okay, looks like this, and get our head around valuation. And that business has been probably one of the very, very few successful private equity IPOs. I think we listed at 360, and it was up around, so last time I checked, it was up around sort of in the $7 to $8 range. So it's been very successful IPO. So I think, and then the summation of all of that is, if we can get that right, then you can generate very, very attractive returns in this part of the market. Now, to be sort of, I guess, put the disclaimer on it, this is above our target return, so we wouldn't go out saying that we're necessarily, trying to deliver sort of 35%, net returns, but we do think that's possible. Now, we do target, we're targeting sort of 20% plus or minus kind of range. It's still very attractive returns, but there is the ability to outperform, and I think that's the exciting part about this market. And I think, to echo one of Brendan's comments at the start, I think private versus public, I think there's an emerging and sort of evolving understanding of the returns attractiveness between those two. But actually, sort of within private markets, the dispersion within top managers and not top managers is actually much more significant than it is in public markets, where everyone tends to be a bit more clustered sort of around the mean or the median. So great returns available, manager selection really, really important. But I think if you can get it right, then particularly in this mid-market space, you've got some really interesting exit avenues open to you. And this just touches a little bit on what I was talking about before. I won't sort of get too bogged down in this, but the idea of Horizons is really to make this to make what we're doing accessible to as broad a range of investors as possible. I think the best way to think about Horizons is that Horizons is effectively a vehicle that sits alongside all of the closed-ended vehicles across our mid-market strategy and our lower middle market strategy. So every time that we're making an investment out of the closed-ended funds, so those are the ones that we go and we say to investors, hey, you know what, if you've got $4 million, you can put it into one of our funds. Horizons is just investing and taking its pro rata alongside those. So the exposure to those is the exposure you're getting is the same. In a broad range of underlying businesses. And so today, Horizons has 16 portfolio companies within it. We've got a number of other businesses that we're in what's called in exclusivity. So that means that we're conducting due diligence on them, and that's sort of the near term pipeline. So we've got a number of others that we're looking at the moment. And so I think there's a couple of comments on this. Maybe the guys can just keep an eye on the time as well, because conscious I'm rabbiting on. So let me know if you need me to speed up or slow down. But I'll touch on a few of these. I think the just sort of maybe before I talk on some of the specifics, I think, and again, Brendan kind of alluded to this, but I think when we take a bit of a step back and we think about thematically what exists in this portfolio, we get really, really excited. And we also think about, could you realistically construct that same portfolio across public markets? Maybe. Could you do it within an Australian sort of higher growth context at valuations that are where you're not having to buy, AWS, Amazon stock? I think it starts to get a bit harder. And so to use some specific examples, I think you've got businesses like businesses like the Mantle Group. So to use Amazon as the example. So the Mantle Group is one of the leaders in Australia in the technology consulting space. They spend all their time helping the largest companies in Australia think about their cloud, digital, AI, data transformation initiatives. So it's actually very leveraged to what's happening in data centers and cloud adoption and AI, et cetera. But, not going out and trying to buy, again, whether it's Amazon stock or trying to get exposure to OpenAI, at some sort of crazy valuation. These are businesses that exist in the Australian market that you can buy at sensible prices. You can partner with the founders, and you can drive value creation together. Another business, Cyclotech. Lots of people are really understand that healthcare is a very strong long-term thematic. Unfortunately, sort of within that, cancer diagnosis and treatment is also a strong thematic. And lots of investors have spent time trying to play into the sort of radiology value chain. So thinking, sort of scans and imaging. We sort of thought, oh, look, that is an interesting thematic. But what is sort of the one thing that rather than going and buying the clinics, what is the one thing that all of these clinics need? And it turns out that actually what they all need is a sort of dose of nuclear medicine, which is the injectable that goes into you when you have these scans. And it turns out that there are a number of universities or sort of public hospitals that have these things called cyclotrons, which is what spins and produces that nuclear medicine. But there's actually one private business in Australia called Cyclotech, which they're actually the leader in that space in this market. And so we sort of took a top-down approach and then ended up engaging with Cyclotech. They had 3 shareholders, one of whom was not in the business anymore, looking for a liquidity event. We started that conversation. We were very fortunate to be able to make an investment in that space. And this is a very high-performing business, very privileged sort of position within the Australian, within the sort of radiology value chain. And really exciting. You can't pull up the ASX and get exposure to a business like that in a meaningful way. And then maybe another example would be a business, Pen10. So Pen10 is it's a cybersecurity business, but really focused around cryptography and secure transmission of data for the highest levels of secret information from the Australian government, Defence Force, both in Australia, but also offshore on battlefields. And so again, cybersecurity, great thematic, but actually let's bring it down a couple of levels to people who have genuine IP, differentiated proposition. We've just done a very large acquisition in the UK. They had a sister company over there. So we've created a sort of Five Eyes or AUKUS business, playing into that sort of opportunity set. And so again, I think we could touch on a whole bunch of these, but again, these are businesses that are in the Australian mid-market. That lots of them would be businesses that actually you might engage with on a daily basis. Businesses like BioPak, if you had a takeaway coffee or got a takeaway sushi or Guzman Gomez, BioPak is the local leader in compostable packaging. And then there are others which you never would have heard of it. You never would have heard of Cyclotech, but it turns out anytime you have one of those scans, you've contributed towards the revenues of Cyclotech. Or Oracan at the top right. You pay a parking ticket. Unfortunately, a chunk of that's coming through to Oracan. So again, I'd say just a really interesting cross section of businesses that we get really excited about being able to invest in. And so then the way Horizons works, as I said, it has exposure to these today. It will take exposure to businesses 17, 18, 19, 20. And then as we're exiting these businesses, so the capital sort of return cycle begins. Again, I'll let the guys at Shaw and Partners sort of touch on some of this stuff. Talk on that as well. It's a rated products with right research people, and then that's probably getting into some of the weeds that we don't necessarily have to touch on. How am I going for time? Because I can touch on some more specifics. But
we got another 5 minutes.
5 minutes? Yeah, okay. Why don't I just touch on, and apologies, I'm just take my jacket off, warm up the front here. Yeah, why don't I just touch on, again, in the spirit of sort of trying to bring this to life a little bit more. I'll touch on two more examples, and then we can sort of get into Q&A. So I think the first is a business called Digital Matter. Again, it's a very classic 5V style transaction. What we're trying to do. So we ended up buying about 2/3 of the business. Business was founded by a gentleman called Ken. He founded the business in Perth, but very international business, doing a bunch of manufacturing offshore, selling into over 100 countries globally, and we think playing into a really nice thematic, which is one around broadly IoT, but specifically around asset tracking. And I think as both technology is allowing people to do this, but also as asset values are getting larger, fleets are getting larger, I think asset owners are getting more sophisticated. Ultimately, there is a need to be able to track and monitor these assets, whether it's a piece of mining equipment or a container on a container ship, whatever it might be. And what the Digital Matter guys have done is they're playing into that thematic, but they had some really great IP around. Often these devices are actually wired in, so they need a power source. Digital Matter's kind of secret sauce is they've designed some of these products to use batteries, and that battery life to be sort of 10 years plus. And so again, as you think about you're trying to replace these things on the side of a container, on a container ship, or on mining equipment, that's clearly not a particularly desirable thing. So having solved a key pain point for the business, for those customers, the business has demonstrated very, very strong growth. I think why did Ken want to do a transaction? I think kind of, again, age and stage, recognition that the business was very successful, but he was seeing lots and lots of opportunity. He wanted some help to be able to prosecute that opportunity, particularly as he thought about sort of international sales and go to market. Since we've invested, partnering with Ken, we've hired a new CEO, CFO, Chief Revenue Officer as well, so sort of growth leader within the business. We're looking at a bunch of M&A, spending a bunch of time thinking about offshore expansion, more offshore expansion as well. So again, very classic transaction for us, and one that we're really, really excited about. And just see what else. I'm trying to give you just a bit of a sense of sort of different types of businesses. So I'll touch on Critical Arc as well. So Critical Arc, so this business, so it sits within Horizons, but it's part of our lower mid-market strategy. So this business is a little bit smaller than Digital Matter. It's a software business, founded in Australia, but selling internationally. Big business in the UK. This business sells predominantly into campus environments, so education campus environments. I think large-scale universities, and then hospitals as well. So again, think very large healthcare style campuses. As you can imagine, the US is a big growth market for these guys, given the scale of some of those university and healthcare campuses offshore. And what the business does, it is the technology and software solution that these campuses use to monitor, track, and ultimately respond to sort of safety and security incidents. So it sounds terrible to say, but kind of like active shooter scenario on a university campus, or even just a medical emergency. The campus security, or actually in some cases in the US, the actual police departments that are responsible for these campuses, they are using this solution every day as a critical component of managing their staff, what they're doing, and how they respond to these types of things. In many ways, not dissimilar to Digital Matter. Thinking about international scaling and growth, adding more capability to the senior leadership team, thinking about some selective M&A as a way to complement a broader product suite. And then, ultimately, we do think that there's a very interesting exit pathway for this business. There are some larger players in this space that are private equity backed. we think this would be a very natural sort of add-on addition for them as well. So we're feeling good around the growth and prospects of this business as well. I'll pause there because again, I could sort of, there's another 14 portfolio companies I could talk you through, but maybe I'll take a pause there and just if there's any questions, more than happy to answer.
No, I've got a couple. Is there anyone here to walk?
Just with Automic Group,
Yeah.
I mean, you're in Darlinghurst, they're in Surrey Hills, virtually neighbours, but how did you actually find them?
Automic Group, we again sort of comes back to the network point. So one of our investors who has had a very successful corporate career in Australia knew the family who are the major shareholders and the founder of Automic. Called us one day and said, "Hey, great business, Automic, down the road. You should really meet these guys." And that was then the start of a conversation around. They turned out, they were thinking about succession, thinking about capturing some of the value they created, but ultimately thinking about how do they sort of continue to accelerate and grow the business. I think, and in that case in particular, across a couple of things, I think one was it is a technology first organization. And so they really wanted someone who understood technology, the application of technology, was willing to reinvest into technology within the business as well. And then the second piece was the business is again, sort of technology business historically focused on listed registry, so providing the registry services for public companies essentially. And they saw a really big opportunity in private markets. So then they thought, well, having someone who understands private markets would be a really good opportunity for us. And then also they felt that if they could round out their service offering, most likely through M&A, that would also be, they'd be able to drive significant cross-sell across their customer base. And so again, we've obviously bring a lot of that capability around thinking about M&A and bolt-ons as well. So again, probably a good example of that investor network really working for us. And then ultimately, I guess, how we were able to differentiate on value we could add.
What a quick question on the returns. Obviously, 34% per annum is quite impressive, but how long do you look to hold these assets for? And is there any sectors that you want to spend more time and you focus on?
So average hold period, I think on the things that we've exited, average hold period has been about 3 years. We typically, though, when we make an investment in a business, we underwrite a 5-year plan. So we're sort of working towards a 5-year plan. But I think the good thing is, if you're investing in growing companies that have lots of opportunity in front of them, then your chance to sort of outperform is significant. And so, where that happens and where we're fortunate enough to have a business that's performing really well, we're not afraid to say, hey, now's the time to exit. Because I think you do have to be pragmatic in private markets. I think again, it's not, you can't just sort of pull up Bloomberg and sell the position whenever you want. So if you get a chance for liquidity, if the business is performing well, you think you can get a chance for liquidity, then we would say you should think long and hard before you say no to that. So that's the first one. And then the second question was just around sort of sectors or
which sort of sectors do you like to focus on?
I think so we are certainly generalist. I think the things we would say we definitely don't want to spend time in is not doing anything in real estate, not doing anything in resources. We just think there are people who are sort of better positioned to do that. The sectors we are spending time on, I think very typical what you would expect. So outsourced business services, education services, both sort of technology and services. Healthcare, like I mentioned, the psychotech business. We're sort of probably skewing a bit more B2B at the moment rather than consumer. I'd say if there was one pocket that we're just keeping a close eye on, it would be sort of consumer discretionary. So we're tending to orientate a bit more towards businesses that are selling to other businesses. But sort of within that, we think there's a great opportunity set, and we're part of the joy of the job, I guess, is that we're not just trying to find the one specific thing consistently. Where we're able to go and learn about new industries, find new opportunities, and then ultimately form a view on whether or not we can grow value in those.
Have you had much pushback when you do bring in new CFOs and CEOs from the existing founder? Is difficult conversation?
Well, look, not
Really, yeah. I think sort of importantly, what we don't do is sort of say, hey, we're 5E and here's your new CEO. It is much more collaborative. I think typically, to the extent that there is a founder who's in a management position, they're usually actually very conscious of the fact that across some period of time, they want to transition out of that role. Yeah, the challenge, of course, is it's one thing to say it, it's another thing to sort of to do it for lots of reasons. But usually they're up for that conversation, and then it's just about engaging, as is right and proper, sort of engaging with them to work together to find the right person for those roles.
Mind just talking about the investment and divestment mechanism you mentioned quarterly, how the valuation and that works?
Yep.
Thank you.
Yeah, sure. So there's probably two things within that. I think there's kind of like there's valuations, and touch on that, and then maybe a little bit around sort of exit, how we think about that. But maybe the valuations was like the key part of the question. So I can start.
Just
on that.
how the liquidity works on a quarterly basis.
Oh, sorry. Yes. Yeah. Okay. So I think how the liquidity works is that in the Horizons vehicle, we always maintain a portion of cash. And so there's that's one piece. Yeah, we're obviously getting applications as well, so we can match applications with redemptions. And I forget, last month that it was probably 30 times as many applications as redemptions, or something of that sort of magnitude. And so that's really the primary way that we're sort of dealing with anyone who needs liquidity. Then you've got cash, and then we've got other mechanisms available to us as well that we can manage it. I mean, we do say to people that this is it is really designed to mirror our closed-ended funds exposure. And so whilst there is liquidity, absolutely, and we understand people's circumstances change, and so that's appropriate that people have it if they need it. And we really do think about this as a capital growth vehicle across a medium-term sort of horizon. So hopefully that answers your question. And then on the valuation specifically, that is being done. It's being done monthly. It's probably done. It's done in a very deep dive sense quarterly, but then sort of cross-checked that there hasn't been a material deviation to that quarterly number on a monthly basis.
Just on the exit strategies, maybe you can shed a bit of light on what it's like selling to private equity buyout, like KKR, for example. Obviously, they're trying to get the lowest price possible, and you guys are trying to get the highest price possible, and even compare that to like trade sale to multinational, for example.
Yeah, sure. So I think what comments would I make on that? I think the first point is that I think we're very realistic about the fact that there has to be something in it for the next buyer as well. And so, ultimately we think we own great businesses that have long-term, very strong long-term prospects. That's kind of like, the first point. We're never, none of the things we're trying to buy are kind of like, oh God, if we hold this thing for, 4 years and 1 day, it's going to be a problem. These are businesses that all of which we'd be happy to own for very, very long periods of time. So the businesses that have sort of good prospects. And then I think the second point around, you're not trying to maximize necessarily, we don't need to maximize to the nth degree, because what we want to do is generate a great return, recycle that capital, go and find the next opportunity and do it again, do it again and again and again and again, as opposed to feeling like we have to, have won and screwed over the person who's bought the business, and kind of eked out the very very last dollar. So I think that's an important point. And then I think, but having said that, I think all the people that we're selling these businesses to are very sophisticated in their own way. Now, a private, KKR is clearly very different to a Bureau Veritas, but ultimately they're both trying to think about, what are the future prospects of these businesses in our hands. I think we love strategic buyers as our sort of primary exit option, because they theoretically should be able to pay you the highest price, because they can there should be some kind of strategic premium that they can pay you. And so we do spend a lot of time trying to identify who those logical buyers would be and trying to educate them on the business, to helping them to sort of craft that narrative. And you know, probably the biggest difference actually is, you know, you can pick up the phone tomorrow, call KKR, and they'll have 6 people in your office in about 20 minutes. If you tell them there's a business that they could buy, as we would, you know, private equity firms, like you're very action orientated, you sort of live to be doing these types of deals. You know, a European strategic buyer that's thinking about where do I want to be deploying capital, like that is something that evolves, takes time. Yeah, so that's a multi-year process. So you really need to be able to take them on that journey of why is it a good idea? Like, who are we and what is this business doing? Why is that a good idea? So you know, your name, the company's name needs to be on a list, on a list somewhere in Europe or the US for some period of time so people can kind of build conviction in the idea. So I think that sort of maybe that time aspect element is actually the biggest difference between the two.
Thanks, Tim. That was excellent. When you think about private equity, you almost have like a consulting business, and then you have your due diligence and your modeling. How does it work with the division of duties? Is there a cross-pollination? You got people wearing a few hats, or how does it work in that regard?
Yeah, there is. I think sort of most of the people who work in our business have come out of backgrounds in sort of finance, consulting, like you mentioned, or have been operators themselves. So, you know, kind of run businesses, been CEOs, CFOs. And so really we're trying to combine, you know, that skill set to ultimately form a view on a business through the diligence phase, but then also through the value creation phase as well. I think as our business gets bigger, our portfolio gets bigger, we still maintain the view that actually a team of generalists with broad experience is most value adding to these companies. But we do work to sort of supplement that capability with, a deep dive on subject X or Y, and we're either bringing in external resources for that, or we have some of that capability internally. A good example of that would be, ultimately we don't run the businesses, the portfolio companies. That we need great teams and great management teams in them. And so what we've done is we've brought a resource into the 5V business who thinks about talent. They think about talent mapping, talent pools, matching, great candidates with opportunities across our portfolio company. And we sort of got to a scale where it made sense to have that capability in-house and to have a more sort of centralized view of it. Now we still work with lots of external providers and recruiters, and how do we sort of source that talent? But ultimately, that's such a integral component of driving great outcomes in these businesses that it made sense for us to bring more specialized capability to that at the 5V level.
Who do you find what's the pecking order in terms of areas that you look for the best uplift in operational output? Like, what are the departments you focus on first, second, third, typically?
Yeah, I think definitely one of the biggest areas of low hanging fruit would be the finance function. And typically that's because it's such an enabler for almost everything else in the business, and even just kind of clean data and using data to drive decision making. And that might be in, what ROI are we getting on the incremental marketing dollar? What's the evidence we're seeing a cross sell, across in the sales org? Might be a pricing opportunity. Are we effectively pricing and bundling and getting sort of all of that right? And so I think, generally, if there was kind of one thing that we would say for most founders, one of the sort of highest leverage things they can do in their own businesses is go and get a really, really high quality CFO. Because if you can do that, it is ultimately the enabler for a whole bunch of other, really good things that can happen sort of down the line. I'd say sort of beyond that, that could rattle off the list of sort of 8 to 10 levers that we kind of think about. But ultimately, usually without good quality data, good quality systems, you know, you can actually end up wasting money in those areas if you're not able to track it.
Question. I'll give you a break. We've got the room until 2, so if anyone wants to stay around and have a chat, glass of wine, feel free to. But look, really appreciate that, Tim. Thanks for coming in.
Thanks, everyone.
Awesome.
Get much to do with the station.
Yeah,